today an update in where we see the Australian economy going, what we're starting to see in the private credit markets, and what we think the impact of that will be on multiple asset classes that are the traditional investment grade asset classes in Australia. Further to that, what we then will touch on is an overview of our private credit fund and how we have designed that fund to address a number of these economic factors and also provide a greater risk return ratio than what is available in other traditional private credit offerings within the market. So my name is Andrew McVeigh. I am a managing partner at Remara. Before we start, we will just go through the disclaimer, just to ensure, obviously, anything that we talk about today is not investment advice. It is general in nature, and please speak to any financial planner that you have or investment advisor before you make any decisions. In terms of the market snapshot, we, as mentioned, are in some very interesting times at the moment. What you can see here is GDP growth expectations in Australia look like they have largely peaked. So 2021, we had off the 2020 pandemic 5.22% GDP growth, and we're now forecasting to finish 22 with 3.7 GDP growth, and that's now starting to curtail off over the course of 23 and 24, as indicated in the chart there by the IMF and Westpac. What that essentially means is monthly CPI has suggested that inflation has peaked. The challenge with that from the RBA's perspective is we are yet to see any significant reduction in workforce participation or employment levels. So as a result of that, we do still have the internal expectation that the RBA will keep rates high for the foreseeable future until there is a wage price spiral and making sure that there is additional capacity available within the economy. What we have seen is a reduction in household consumption and an expectation of still positive outlook for businesses in terms of their investment opportunities. However, that consumer growth and consumer sentiment is certainly turning down to be much more negative. Rents are increasing in terms of net migration into Australia and the unavailable number of properties for people. So we have seen rents increasing, and employment fell during January, but that's a traditional seasonal pattern that we have seen. So we don't read too much into that at this point, but we'll be monitoring that trend on a go-forward basis over the next few months to see if that does continue, which would break it out of any formal seasonal pattern. In terms of the credit market, this chart here is from S&P. It's prime residential mortgage lending. So it gives a really good view of the overall residential credit market. Couple of things to note here. What you will note is we do have an escalation in the arrears 30 days plus, which is on the right-hand side. The green line in the middle of the chart, that's essentially the standard variable rate. So you can see that ticking up from around about the 2.5% mark to just under 6%. And then what you'll see in the December 22, right on the right-hand edge there, is an increase in the number of arrears. Now, while this is still below the long-term average, it is important to note that that long-term average includes the GFC period of 2007 really to 2012, which looks like it has skewed and will have skewed that long-term average. On resetting that average from 2014 to 2022, we are getting above the long-term 30-day plus average arrears. What's interesting to note on prime mortgages is approximately 7% of the market in terms of prime mortgages have an LVR that's greater than 80%. So that means that while there is an increase in arrears, there's certainly a lot of available capital within those loans. So our expectation is prime borrowers will not suffer significant distress, and prime borrowers are also unlikely to have substantial defaults that would infect the banking system and also negatively impact the residential mortgage market. As we move to non-conforming loans, so generally non-conforming loans are loans to people with poorer credit scores, defaults on their history or track record, and essentially lower quality borrowers. What's interesting to note here is from 2016, 2017, the substantial increase in the total current loan balance, which is that green line that escalates fairly quickly on the right-hand side of this chart. What you will note is obviously the arrears ratio in December 22 does start to tick up and tick up quite noticeably. However, the bigger concern from this chart here is the growth in that non-conforming loan book as a total size. In terms of this market, circa 9% of this market have an LVR of greater than 80%, and those LTVs or LVRs are essentially measured at the time the loan is put in place. So what that essentially means is with some recent reductions in the residential mortgage market, there could be a larger percentage of this non-conforming market that would be above an 80% LTV. So this is certainly one of the areas that we are monitoring quite closely. And if you are looking at credit quality or investments into credit products, staying away from potential non-conforming areas in the foreseeable future would be something that we would be recommending. At Remara, we focus primarily on prime grade borrowers, and the reasons for that is it's a larger market here in Australia, but also we're looking to lend and procure private credit assets from very high quality borrowers. In terms of prepayment trends, this is quite interesting here. So what we're starting to see is non-bank lenders are starting to be prepaid at a greater rate than what they have previously been, and you're starting to see major banks actually decline in their prepay rates. So what this essentially means is there's actually a number of borrowers moving from non-banks to the major banks for their mortgages, and that's a few reasons for that. First of all, it's a lower interest rate generally offered by a major bank. Second of all, a lot of non-conforming borrowers or borrowers to non-banks will have accrued equity within their property over the last few years, and that equity allows them to go and refinance to a major bank. And there's generally in periods of credit distress or credit contraction, there is a general requirement or desire for people to move back to major banks as opposed to the non-bank shadow bank sector. What we have seen is the reduction in the prepayment trends will essentially mean that underlying borrowers are refinancing their loans, but just as importantly, they're also not ahead of their mortgages or are ceasing to continue to stay ahead of their mortgages. And that's a general requirement or a general outcome when you have interest rates move at such a rapid pace. A lot of people don't change their repayment structures when they first set their loan and will just be paying additional prepayments as the interest rate declines. And then alternatively, when the interest rate increases, they start eating into that prepayment, which is something that we can see here on this chart. In terms of total assets for securitization, this is really important because it goes to the general overview of the market, but also the market share and the change in market share. So this chart here indicates the total value of securitized assets for ADIs, so banks versus non-ADIs or the non-bank sector. And what you can see here is over the course of 2018 and 2020, we really had an inflection period where now we have a greater portion of non-ADIs undertaking securitization at a period where total assets actually increased as well. So what this essentially means is we now have a bigger non-bank sector than what we previously had. And that non-bank sector is traditionally financed through securitization. And there's a couple of factors for that. One, it's banks have left some traditional lending markets, such as asset finance, leases, and also certain areas of consumer finance. And the reason for that is changing risk weightings from the bank. And there's also a significant increase in the number of non-bank participants in the market, really looking to try and capture that market share that the banks have let go based on their own risk rating requirements. In terms of new loan commitments on the housing side, as I mentioned previously, we're starting to see credit to contract. So what you'll see here is January 23, there is a significant and clear decline in the amount of new credit being provided to both owner-occupier and also investors. And that's both on the seasonal and the trend basis. So across all types of information here and data sets, we're starting to see a significant decline in the new loan commitments, which leads to the reduction in the GDP, as mentioned in that first slide. We're also seeing that in business finance. So while investment is still relatively high, what you'll note here is there is a general reduction, particularly in the purchase of property, and that isn't property in terms of real estate, it's the purchase of goods, materials and assets. So it's very broad. And what you'll see is there is quite a substantial decline and reduction, and a noticeable decline and reduction that is starting to come through in terms of the purchase of property and hard assets. So we expect that to decline. It's what we have seen at the coalface in terms of our lending businesses. And it's certainly something that we are very much alive to. The challenge that we see going forward for most credit investors is ensuring the credit quality and also the asset bases that are being lent to, and ensuring that the right valuations, right metrics, as well as the right credit-worthy borrowers are being selected in terms of an underlying portfolio. Now, what does this mean in terms of assets, and what do we see in terms of potential impacts to alternative asset classes in the asset universe? So, summary for us is credit and liquidity is contracting. We're seeing that through institutional levels, SMEs, businesses throughout the market. We're seeing a reduction in the availability of liquidity, and that will have some flow-on effects over the course of the remainder of calendar year 23 and potentially into calendar year 24. Growth and inflation looks like they have peaked, and that's going to be largely driven through that reduction in credit and liquidity. Prime borrowers, we think both consumer and SMEs will continue to perform. There is built up liquidity within those buffers, and there is, we've gone through a fairly long period now of sustained economic expansion. So there is liquidity available in certain pockets of the market, and that generally is focused around that prime borrower market. Non-conforming or subprime borrowers, we're expecting an increase in arrears and potential losses to continue. And we think there are going to be a number of market participants who will suffer some fairly significant losses if the credit and liquidity continues to contract and does so at a fairly rapid pace over the remainder of FY23. Secured lenders, so mortgages and assets, will perform much better than unsecured lenders. Kind of goes without saying. However, predominantly anybody with a mortgage security or mortgage coverage should be in a position where they will recover any worked out assets and assets in terms of cars or other heavy vehicles will obviously perform much better than the unsecured lenders that you start to see in and around this market that have performed really well over the last few years. While we've had very buoyant economic conditions, they will tend to struggle now in periods where credit is contracting and their borrowers are unable to refinance away from what is traditionally high incumbent unsecured lending participants. Residential mortgage lenders, banks, our expectation is they will continue to support the market. We saw that through the GFC period and post-GFC period, where banks were able to work through books, did not go through significant realization or default foreclosure processes, and we would expect that to continue over the course of FY23 and also FY24. If banks do suffer losses or they do have an increase in arrears, we would generally expect them to work through those assets as opposed to moving straight to the foreclosure. And I'll touch on in a moment what that means essentially for the residential mortgage market. Impact on individual asset classes, and credit and liquidity has an impact across all asset classes. It's quite pivotal in terms of ensuring economic growth and prosperity, and the lack of credit and the lack of liquidity will certainly impact most asset classes negatively. What we are starting to see is the reduction in earnings growth for the equity market is likely to lead to an expectation of continued volatility. We've seen a fairly volatile market over the last 9 months through what has been a period of fairly dramatic interest rate increases. And as a result of that, that has led to a lot of capital erosion and volatility within the equity market. We don't see that ceasing for a period of time. So it's our expectation that that will continue over the course of 23 and potentially into 24 as the RBA looks to hold rates where they are and potentially adjust slightly or potentially cut as we get later into 23 and early 24. What it means for residential, particularly on the real estate on the residential side, is we are looking at stable price expectations. We've obviously had a decline in the market, and there's been a lot publicized about this. Our internal data is suggesting the market's down around about 20%. In most major metro areas within New South Wales. Victoria looks to be down around about 15% at the moment. Queensland, interestingly, looks to be down at a lower percentage, so around about the 5% mark. And the Queensland property market seems to be very buoyant at the moment. Again, primarily driven through migration into the state and out of the southern states, particularly Victoria and New South Wales post-pandemic. And that is holding up the Queensland market. We also expect stable rental income. Obviously, as we mentioned, rents have gone up quite substantially over the last 24 months. So we don't see significant growth from this point forward, but we also don't see a significant retraction in rental income. On the commercial and industrial side of real estate, we actually see quite a negative potential market commencing here, particularly on the commercial, so office buildings. We see pressure coming on rental income growth, pressure in terms of incentives and effective net rents, and that's obviously going to lead to pressure on valuations. The pressure on the valuations that we'll see on the office side will be driven by two things. One, a sustained increase in the interest rate, which will obviously impact valuations and DCF calculations that are done to measure these assets, but in also the net effective rent we're expecting to reduce in terms of greater incentives needing to be offered to tenants on the basis of bringing them into that building and signing a long-term lease. It's our expectation that for the foreseeable future, most workforces have changed and office space requirements are not as substantial as what they once were for most organizations. And a lot of businesses now and a lot of buildings are seeing hidden occupancy in terms of fully let floor plates. However, they're only at 50 to 60% occupancy on a daily basis. So when renewals come up, we're expecting a significant reduction in the amount of space most tenants need. And what that will lead is a flight to quality, but it'll also mean that there'll be a lot of buildings and a lot of vacancy that will be chasing tenants. And that generally means incentives will increase. On the industrial side, we're a little bit more bullish than what we are on the commercial. Obviously, industrial is driven primarily through transport and logistics within Australia, as well as heavy industry. If we see a reduction and a contraction in business investment, that will obviously flow through to the industrial sector. We are not expecting a significant reduction in the industrial area, but we do still see some pressure on rental growth and income, and obviously pressure on valuations again, as industrial assets are primarily valued based on rental income, rental streams, against the risk-free rate being the RBA cash rate. From a fixed income perspective, reducing interest rate risk is what we see. We think we're close to the top of the hiking cycle. There's a lot of conjecture around what that means, and will there be cuts, and at what point will that come through? We're still working through what our internal house view is on that. However, we do think we are getting close to the peak in terms of the interest rate risk hiking cycle. What that does mean is there is the potential for capital volatility in fixed income instruments that are both traded as well as privately held within the market. From a private credit perspective, diversified exposure, I've split the private credit market into two different subcategories here. So diversified exposure is smaller tickets, granular large pools, lower dollar value obligors, and then we've got real estate, which is generally higher dollar value, significant concentration in single assets. And the reason I've split those two is they have two very different profiles. So diversified exposure is something like a pool of SME credit, $80,000 to $100,000 average ticket sizes, good seasonality in terms of established loans with payment records and payment history. We see that area of the market, if it's focused on prime borrowers, as having a stable income profile and a very stable capital value. We actually think that area of the market will outperform over the next 24 months. Whereas looking at real estate, we do see a slightly elevated volatility based on interest income and income, and a slightly elevated risk of capital value, particularly in the larger real estate projects around built form units, apartment blocks, and large scale master plan developments that have vertical built scale. We see risk within that area of the market. However, we see certain subsectors such as land subdivisions, smaller developments such as townhouses, duplexes, and those as providing a good source of income, and also probably a lower risk of capital value or capital losses. So that kind of brings us to our overview on the market in terms of what we've seen, the economic landscape, and what we've noticed in terms of outlook and the impact that we see on other asset classes. Moving now to our private credit fund and how we've designed our private credit fund to really address a number of those points that I've just discussed. So the fund mandate for us is a registered managed investment scheme. Our fund is live at the moment. We're currently achieving around about 11.5% on a per annum basis. The active strategy for us is one where we are investing into a large pool of diversified SME credit as well as smaller scale real estate credit. So we're really looking to lend to prime borrowers, ticket sizes $80,000 to $100,000 in size, established businesses that have been operating for at least 2 years, and cash flow underwritten. So looking at their bank statements on a 12-month basis, understanding how those SMEs manage their cash, and essentially how those SMEs ensure that they've got the available funds to pay for any loans that they've taken. The fund invests in a vertical integration model. So what that essentially means is we have ownership and control over the credit of the underlying originating businesses, and we as Remara essentially have our first loss capital into each of the warehouse trusts, and that essentially means that we will suffer any credit losses before our investors suffer any credit losses. So it creates a fairly significant alignment of interest there with fund investors. The return profile of the fund is RBA cash rate plus 4% on a per annum basis net of fees. As I said, we're currently achieving 11.5% on a net of fees basis. So we're outperforming our fund profile at the moment. And in terms of sponsorship, Remara currently has more than 650 million of funds under management. And this latest private credit income fund is our newest fund, focused on providing investors a monthly income stream and a quarterly redemption opportunity on what is a very strong risk reward portfolio across a diversified asset class. The underlying credit investments, as I mentioned, is a highly diversified pool. So we've got asset and equipment finance. These are generally trucks, trailers, operational equipment such as utes, etc. Business loans, and we've got two forms of loans here, both term loans. So these are amortizing principal and interest 3-year term loans, as well as an overdraft product, which is very much akin to a traditional bank overdraft. We've got trade finance and invoice finance, so assisting SMEs with their cash flow requirements within their business. We then have real estate, both at the completed level as well as development. Particularly on the development side, we are focused on smaller ticket projects, so circa $3.5 to $4 million and below. They're generally land subdivisions, land acquisitions, duplex builds, or townhouse developments. So focused on the smaller end of the market where there is less risk around construction, there's less risk around the builder, there's less risk around market movement substantially impacting our credit position. And that's the area of real estate that we are very much focused on. Consumer credit, we have some small exposures across consumer car assets, so chattel mortgages and mortgages on consumer cars. And we also have exposure across insurance premium finance, which is essentially businesses using a similar concept that most individual consumers use in terms of paying their insurances by the month, as opposed to paying their insurance program as a lump sum upfront. What we like about this strategy, and the reason why we've put this strategy in place, is we are actually able to generate far better risk reward returns for investors based on the diversity of the pool. So as we look at these underlying credit assets, we're essentially being able to create liquidity. Trade finance, invoice finance, and insurance premium finance are all assets and loans that are generally 90 days to 120 days average term. Business loans and asset equipment are generally 3 to 4 years. Consumer credit could be anywhere from 3 to 5 years, and real estate is generally 12 to 18 months. So what that enables us to do is to be able to bundle together a highly diversified pool of private credit assets, reduce the individual obligor or single obligor risks and exposures, and be able to provide what is a very healthy return to investors without significantly increasing the risk of single obligor, geographic, asset-based or asset backing. We're able to provide what is, for what we believe, a fund and a return that's without peer in the Australian market at the moment. The vertical integration edge that I mentioned previously is one where we, as Remara, have a material investment in our underlying origination businesses. That essentially means that as those businesses procure credit and write credit assets, if there are any losses within those portfolios, and I've got our loss statistics that I'll touch on in a moment, essentially we, as the equity owners within those platforms, essentially lose our money well before fund investors lose their money. So that creates a significant alignment of interest with investors. And the pool that we've created, as I mentioned before, provides us liquidity and the ability to be able to provide quarterly redemptions. It maintains a yield, and a fairly stable yield, which is very attractive in today's market. And most importantly, it provides diversification. So we're not singly concentrated on individual assets. So if there are losses in those assets or that obligor, there needs to be very substantial losses across the entirety of the pool and the entirety of the 9,000 contracts that we invest into before investors ultimately suffer any type of income loss or capital loss. The platform advantages for us, there's a couple here. So first and foremost, liquidity management. As I said, we've got long dated contracts, we've got short dated contracts, and we've also got medium dated contracts. It provides us a really good mix of ability to manage the liquidity. It provides short-term funds that mean we can invest, we can offer redemptions on a quarterly basis, and the payment structure means that we can also offer monthly and provide monthly income returns to investors. The portfolio return overall is one that is heavily diversified across a number of different contracts. So what we're able to do is blend down the overall exposure to any one single contract, but still maintain the overall weighted average portfolio return. Aligned management, as I mentioned, we invest 5% first loss into every single loan across the platform. So what that essentially means is we have invested our money at the lowest tier end of the loan across every single asset. So we are aligned. We're making sure that credit is appropriate. We are responding to market trends, and that we are writing credit that we don't want to suffer a loss on first. Limited concentration, as I mentioned, the highly diversified pool of circa 9,000 contracts essentially means we've got the ability to be able to limit the individual concentration across whether it's obligor level, geographic level, or even asset class. And the floating return nature of our assets essentially means that we're able to move with the RBA rates. And this is obviously quite critical and very much at the top of most investors' list as they look at private credit investment funds. Particularly over the last 9 months with the RBA increase, the floating return nature of assets that we invest into and instruments underlying the fund investments means that we can move our returns as and when the RBA moves their rates, whether they be up or down. In terms of the credit layers of protection, this is quite critical in terms of understanding the structure. So we've got 4 different layers of protection. The base layer is the individual contract level. So these are all secured loans. They have director guarantees that provide us coverage across the individual asset, as well as any shortfall in recovery across that individual asset. 90% of our underlying borrowers have property, and that through that director guarantee, we essentially get coverage through to their underlying property, whether or not we take a mortgage or a caveat on it from day one. The product level layer provides a significant level of diversification. So as an example, on our asset finance and business loan books, that's more than 8,000 contracts. So that essentially means that individual obligor exposure is very much diversified and very much eliminated in terms of significant exposures. As we roll up then into the investment structure layer, this is where we bring in multiple product classes, and there's a further level of diversification that essentially occurs there. So we add in our real estate exposure, our investment insurance premium, finance exposure, asset business loans exposure, trade and invoice exposure. So once we mesh all of that together, we then have even further diversification across the pool. Within that investment layer, these investments are made into warehouse trusts and vehicles that are externally managed. There's backup services, there's independent trustees. So there's a level of internal and external governance that's applied at the investment structure layer. And as we move up into the fund layer, that's further amplified in terms of having independent responsible entities, as well as fund administrators, unit registrars, legal services, where essentially we've got the ability for independence and review at every step of the way. And that essentially leads into a very strong look-through level of protection. Ultimately, we are risk managers. We manage that through private credit assets. So risk and risk mitigation and management is at the forefront of what we do and how we operate. In terms of the pool overview, this is a really interesting slide to provide some exposure of the diversity of the underlying pool. So in terms of contract type, what you can see there is at the moment it was a pool of 518 million. With a very strong exposure in terms of shadow mortgages, which obviously provide very good strong coverage. In terms of original contract value, you can see more than 50% of the pool was under $100,000. Geographic spread is what you would expect with a lean towards the 3 eastmost states in terms of New South Wales, Victoria, and Queensland. Director Equifax banding is a really interesting point. So what you'll note there is about 50% of the pool is between 700 and 900, with only a very small amount of the pool below 600. So Director Equifax banding is essentially the credit score of the lead director in the borrower, and essentially probability of default levels once you get to a director score of 600 and above are generally about 3.5%. and that's before the recovery of the asset. So what that essentially means is the underlying credit quality is prime. The underlying borrower profile is very strong. And what you'll see there, coupled with the industry exposure and the security, means that we don't have any significant industry exposure with the transport, postal and warehousing, and that's predominantly the transport industry, being the largest industry exposure at just under 30% there, with trucks, trailers being the largest security asset that we've got at a tick over 35%. So essentially what we're looking to provide and what these statistics provide is a very diverse pool of individual underlying loans, very strong prime borrowers with great credit scores and very strong credit histories, with no substantial exposure or concentration, whether it be in certain assets or industry. In terms of the underlying performance, our arrears profile since July 21 is extremely strong. At the moment, we're sitting with about 25 basis points, 30 days plus. We've got 12 basis points, 60 days plus, and essentially 1 basis point over 150 days. So yeah, that's a 39 basis points of arrears, and that compares to the residential prime market, which was around about 76 basis points. So extremely favorable in terms of the arrears profile of the prime market overall. Although we are comparing ABS or SME exposures to residential exposures, we do have a prime book, and the current arrears ratio in comparison to generally accepted arrears for prime borrowers is extremely strong. In terms of the losses since inception, these are net losses. So the blue line there is gross loss. The purple line is the net loss after recovery. At the moment, we're sitting on around about a tick over 40 basis points actually of net loss. So at the moment, our excess spread across the pool is 4.5%. Our net losses come off that excess spread, and then we have a 5% first loss. So we're looking at credit enhancement of around about 9.15% across the pool. So what that essentially means is we would need to have a fairly substantial, so close to a 20 times increase in credit losses before we were to look at having any potential capital loss for underlying fund investors. So that's a very strong investment offering and a very strong net loss profile, which is been the underpinning thesis in terms of creating the private credit fund and bringing together the pools of highly diversified assets that we have to secure that. In terms of the fund performance, so the track record, the fund's been going now since August of last year. It is a strategy that we've built off the back of a number of private placements that we've managed, as well as a number of public bond deals that Remara has undertaken over the last 24 to 36 months. So what this graph indicates here is the purple is the increasing in the RBA rate on a per month basis. The blue is our total fund return. So it includes essentially our active gain. So what we record above and beyond the risk-free rate, and the red is the target return. So that's the RBA plus the 4% net of fees. So as you can see here, for the last since the inception of the fund, we have outperformed on a monthly basis, and obviously on a net annualized basis, we've outperformed what our target return rate is, and we have provided a very strong offering for investors. The fund is currently finalizing a rating process with Foresight Analytics, and that will be available within the next fortnight. The fund is also being finalized for registration, so it will be open for investment on Netwealth and Hub24 platforms from April. In terms of fund performance for the broader business, the Remara 2021-1 Credit Trust is a fixed rate note trust, and we've provided investors the fixed rate return for that since its inception in 22. And then we also had a private placement arrangement that we ran for a number of years, which is underpinning the private credit income fund thesis, and that has a very strong, solid return. Please note that during that period, the RBA rate was 0 or close to 0. So those returns are all active returns or active gain returns above and beyond the RBA rate.